Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this video and the article that goes with it was inspired by a reader of mine who commended me for how well I explained the criteria of how I value a company and also how I can clearly illustrate when they're overvalued or undervalued. But he also indicated that I was remarkably imprecise when I was trying to identify the time periods in which these predictions are likely to work out. Now, I read that as saying, how long does it take an undervalued stock to move back to fair value and make me money? Or how long would an overvalued stock take before it would start dropping and I would lose money? So what I've done here is I've put together a series of companies that I've written about in the past to use to illustrate that there is no absolute or precise answer to this question, but it is an excellent question. But there are factors that will affect how long it takes a company to recover from being undervalued, or how long it takes a company to move out of alignment when it's overvalued, or how long you might have to endure poor performance from an overvalued stock. So I'm going to go through some examples here. I tried to provide a series of different examples, but I also, to try to make this a little more pertinent, I've picked times where I've actually written articles on the various companies I'm covering here so that we can essentially evaluate what we're looking at here based on what I've done in the past in terms of writing articles about certain companies. With my first example, I'm going to take a look at Microsoft. I wrote an article in September of 2010 titled, "After a Lost Decade, Is Microsoft a Buy?" So the first thing I'm going to do is I'm going to find September of 2010 here on the graph, and I'm going to mark it with my calculator functionality. So this is when I wrote about the stock. Now there's a clue here. The period prior to this, the 10 years prior to this, was often referred to as the lost decade. I'm going to show you that in a moment. But let's talk about a time when Microsoft was undervalued. Now I want to clarify things. Back during this time frame, you can see if I move my mouse here, the bottom line there, Microsoft was trading at 9 and 10 PE ratios during this time. There's 11, there's 10.5, etc. So this was a time when Microsoft was trading at a very low PE relative to what I would call the intrinsic value PE of 15. I do want you to notice, for now at least, that today the stock's trading at a blended PE of about 28.46 up here. But regardless, in the article I indicated it takes about 3 to 5 years, because I want you to understand what's happening here. When you buy a company, you're buying its earnings, or you're investing in its earnings power, or you're investing in the business. These numbers are not going to be precise because I'm, picking intermittent time frames here, but Microsoft has a June fiscal year, by the way. June 2010, Microsoft earned $2.10. Then it earned $2.69, then $2.78, and $2.57. Now, I want you to notice that growth for these first couple of years was very strong, but then growth for the next 3 or 4 years was weak and actually negative in 2013. You can see how the orange line turns down here. Nevertheless, if I measure this and go ahead and look at it for the minimum business cycle of 3 to 5 years, that's to me a business cycle, because it takes that much time for a company to build up this profitability and generate this kind of dividend growth in order to actually make a shareholder money. So if I then look at September of 2013, this would be 3 years later. Even though the stock was still undervalued, in other words, it's still only trading at a PE ratio of 12.8. Remember, I'm suggesting that a 15 PE is the actual, what I would call intrinsic value. But as it was moving towards that over this time frame, with volatility in between, I want you to notice, you'd have made about 13.4% a year on your money. Now, what's really interesting about this is Microsoft has now gone on to generate significantly more rate of return, because the company has now gotten significantly overvalued with a current blended PE of 28. So I missed it by a month here, but you get the measure. It's not going to change this much. You're averaging over 22% a year over this time frame on a stock that stayed undervalued for several years and then became fairly valued for like a minute and then got continuously stayed separated from being overvalued. And this has gone on, I want you to note, for several years here. But let's look at it from the overvaluation point of view. Now, overvaluation is a relative term. During the irrational exuberant period in 2000, you see that Microsoft was trading at PEs. There's 56, 58. At the peak here, I've got a PE of 71.8, or we'll call it 72. But even if you measure this at a PE close to what it's currently trading at right now, there's a PE of 25, and it's currently trading at 28.46. That's, not quite double what I would call the normal valuation. If you look at this lost decade that I was writing about when I wrote the article in September, you can see that your rate of return owning Microsoft at that time was only about 2.4%. But watch this. If I move this back, if I take my scrolling bar here and I move this time frame back to roughly the end of when this occurred, I want you to notice that Microsoft was growing at about 10% per annum during this time frame. So the company was doing great. Overvaluation, though, was a major headwind here that literally kept shareholders from making any real money from peak to trough here. And this is a relatively long period of time. I missed the peak. I don't want to get too finicky. Losing an average of 9% a year, it was worse if I'd have went to the peak. So the bottom line is valuation is extremely important, and there is no precise time, because let's look at a couple other aspects of Microsoft when it was undervalued, going back to that notion for a moment, because I think that's really important. When you look at Microsoft from the standpoint of being undervalued, I do want you to notice a few things here. It got extremely undervalued during the Great Recession, by the way, from fair value. And I do want you to notice something here. When Microsoft was actually overvalued coming into the Great Recession with a PE of about 23, it kind of immediately fell to what I would call fair value, a PE of approximately 15 here-ish in this area. And then from there, it fell down to where the PE got down to under 10. But I want you to notice it recovered within just a matter of months, probably just a year or so. Then it got undervalued again, even though earnings growth was staying strong during these 2 years down here. And I can shorten this a little bit so you might be able to see these numbers a little bit. The growth was still good, but then we went through this flat period here where growth wasn't so hot, and Microsoft's stock price languished down here in this 10-ish PE ratio range. And then all of a sudden it started to increase dramatically. But I do want you to notice that growth rates, even if I just look at these last several years here, its growth rate hasn't really changed all that much. Not enough to justify the PE ratio almost tripling. But anyway, overvaluation can really hurt you for a long period of time. This is a case where Microsoft's valuation just steadily drifted downwards until it finally got into fair value. It took almost 10 years in this example. But then once it got undervalued, it recovered in a year. And then once here it was undervalued for several years, and now it's been overvalued again, in my opinion, for the last several years. So anyway, that's starting out with Microsoft. Let's move on now. With my next example, I'm going to move a little quicker now. Let's look at Apple. And I wrote an article in October of 2011 titled Steve Jobs' Legacy and Apple's Record Will Live On. This was, of course, shortly after his passing. Apple was trading at around a 14 PE ratio here, 13.9-ish I'm getting when I look at it right here. And I do want you to notice that the company still grew very fast. Growth over this time frame, starting back here to September of 09, averaged about 25% a year. So my P equals growth rate fair value PE would have been PE of 25.3 rounded. But yet Apple was only trading at a PE of approximately 16. That's what the blue line is. Now keep in mind that's a reference. So the blue line is a PE of 16. This is below 16. This is a PE above 16. You can just kind of track with your eye to see how that worked. Now, if you're looking at that again in terms of the next 3 years, so if I go to October of 2014 here, you're going to see that you would have averaged about almost 25% a year analyzed, and yet it could be arguable that Apple continued to remain undervalued during this time frame. So, there is no precise time frame, and if you use the blue line as your valuation reference here, you can see it was undervalued for a couple of years here and then went up. But I do want to make a point, since I just said that. This is 2.5 years. This is a couple of years here. People have this instant gratification today. 2 years is a long time. They buy a stock and a month later it's down and they're saying, oh, I made big mistakes. I should have never bought that stock. It takes time for a business to generate value. Now, with my next example, I'm going to take a quick look at IBM. I wrote an article saying I feel like a thief buying IBM at today's low valuation in August of 2014. Now, I'd also like to disclose that I purchased IBM at that point in time, and I've continued to own it since. And if you look at what's happened to IBM, which I illustrated, going out to almost 5 years now, the time frame I've held this, my total rate of return has actually been negative. However, I bought this for one reason and one reason only. I bought it for the dividend, and I considered the stock to be extremely undervalued. Now, to be honest about it, I didn't expect earnings to be this weak although I did expect them to have some kind of flat earnings growth. But we've had some really poor performance operationally with IBM over this time frame. But what has been good and what I've been happy about is the dividend. I want you to notice that the dividend has gone from about $4.25 a share to $5 to $5.50 to $5.90 to $6.21, etc. So if I measured this time frame here of when I purchased IBM and look at it from a performance point of view, and this will be close, my dividend has grown by about 11% a year, even though I'm losing money technically on a total return because my capital was down about 25 or 30%. I have picked up some nice dividends, and the dividends continue to grow. My dividend growth has been about 11%, and I've gotten more dividend income than I would have gotten had I invested in the S&P 500. But the real point is this: I do consider this company a turnaround opportunity. I do plan on owning it for several more years. It's got a 4.75% dividend. It's an A-rated company. You know, everybody, obviously knows who this stock is. I think it's a company in transition, and I'm willing to own it, but I'm different than a lot of people, so I want to make that clear. But anyway, IBM has been one where the valuation has actually made sense, because what I tried to stress in the article, the earnings did not grow after I bought the stock. So when you're buying an undervalued stock, I said in the article, it's inevitable it'll return to fair value, and I still believe that. But the point is that that's as long as the fundamentals stay strong. Now, IBM is still profitable. They still have good fundamentals. If I look at the stock from some of the other metrics, which is, dividend coverage, they've got ample operating cash flows covering their dividend. And as I've talked about in the past, from free cash flow, their free cash flow is amply covering the dividend. So I bought this for the dividend. So I'm happy because I'm continuing to get a growing dividend income, and I have no intention of selling IBM today. I probably intend to own it for another 5 or 10 years. Unless, ceteris paribus, all things remaining equal, unless something dramatically bad starts to happen to the company. But instead, I'm seeing some good things starting to happen to the company. So I'm content to hold. But this is one that has not worked out, in that business cycle as of yet. Moving on to my next example, in May 2010, I wrote an article on Medtronic, and the title was High Quality, High Growth, More Dividends. So, the stock had become undervalued. Now, there's a couple of lessons here. I do want you to notice that I purchased it on, let's assume I purchased it on May 31st. I only have monthly closing prices on this graph. The price was around 39. Well, by August of 2010, the price was down to 31. So it's down around $7, $8 a share initially. But then it started to move back towards alignment here. And I do want you to notice that if you're going back to this business cycle in approximately, the 3 years that I talked about as my minimum business cycle holding period, you'd have averaged about 11% a year owning Medtronic over this time frame. Now, had you still continued to hold it while it became overvalued, your rate of return would still be about 13%, but you would have, counting dividend income, tripled your money. A $10,000 investment, back in May of 2010, including dividends, would be worth just under $31,000 today. I'll take that all day, every day. But now I want to show you something really interesting about Medtronic, because this is one of these companies that went through the irrational exuberant period with very high valuations. And I want you to notice, and actually let me extend that out because I don't like this 1 year of earnings here, but if you look at what this company was doing, trading up here at PEs in the 40s and 50s. Now that's is irrational exuberance, and that is real high. That's 2.5 times the current PE, I grant you. But the point I want to make is, other than this down year they had coming into 2000, you can see that the company's earnings growth was very, very strong here. Double-digit earnings growth all the way through 2006. So from this point, to this, actually, even to this point, earnings growth was very, very strong. But look at the stock price. The stock price stayed, here it was 54, here it was 40, here it was 47, here it was 55. All these years later, virtually no movement. Here it was 46. And then eventually when the recession came, it got down into the 20s before, I wrote the article and it started to recover again. So, in this case, high valuation lasted a very, very long time. But even though there was nothing bad happening, meaning we didn't get a big drawdown in the stock like people fear, this was like the dreaded, drip torture method, drip, drip, drip. You just never made any money here for almost a decade if you'd held Medtronic when its valuations were high like that. It's not precise, but there are concepts that you should be able to understand what your risks are and how valuation can affect. With my next example, I'm going to cover Aflac. I wrote an article saying essentially that I expected the PE ratio should be double what it was, and so should its price. And I did that on November of 2011. So if I go find here November of 2011, I want you to notice that the PE was about 7. Okay, the PE today is only 11.8, so I didn't even get my double after all these years. However, if I run this out to November of 2016, which is basically the 5-year time frame, which I said a minimum of 3 to 5 years. So this is my 5-year time frame here. I would have averaged about 13% a year, and it might be slightly different what I had in the article because I hit a different time frame here. But that's a pretty good rate of return. But I want you to notice the stock has been making us money all along here. If I run this all the way out to where it sits currently, a $10,000 investment would be worth about $26,000, averaging over 13% a year. And I still think the stock is worth all day long a 15 PE ratio, even though it hasn't traded at that in years. But I do want you to notice that prior to the financial debacle, I like to call it, there was a time when Aflac was trading at PEs in the 17, 18 range all during this time. So, it's been steadily moving back towards that. And this is one I've been criticized on in the past, and I'm long this stock. I own this stock, and I've done very, very well because it keeps moving back towards alignment. Even though it's not reached it yet, I've made money while I've been waiting, so I'm really not too upset. Now, I do want to focus a little more on this idea that I kind of introduced a couple of minutes ago, that, it all depends on whether earnings continue to grow. So I wrote an article on Dover. It was actually early July of 2011, and I titled it, "Is Dover a Cyclical Growth or Dividend Growth Stock?" And the point is, the growth rate of this company, depending on where you measure it, can be quite good. If I eliminate some of that, you've got 5 or 6% growth, but you also see periods here where you get, 74% growth, 29% growth, 49% growth. That's the cycle that I was referencing in the article. Now, if I measure this over that 3-year holding period, it kind of ironically, I hit it about right here, and I ended up making 19.5% a year annualized. But because this is a cyclical stock, if I'd have measured it several months later, my rate of return was down to 3.8%. Then the flip side of that is, because it is a cyclical stock, part of the message I'm trying to convey here, time in the market is more important than market timing, or at least is as important as trying to time the market. Here, you're averaging over 11%, but the key to a company like Dover, if your investment objectives are correct, is you want to be investing in this stock because it provides about 8 to 8.5% dividend growth historically, and has for a very, very long time. So, this company has a great long-term dividend record of growing at about 8% a year. And so if you're buying it for the income, if you're willing to accept the cyclicality and the volatility, it can make money. But the point is, you're going to have different reversions to the mean, if you will, with a cyclical stock like this, because the cycles often get in the way of the recovery, or even if it's overvalued, they can also bring the value down very, very quick. With my next example, I'm going to take a quick look at Lockheed Martin. I actually wrote about this stock in July of 2013. Okay, so approximately right here. And I'm going to go backwards on this 3 years, because if you go back 3 years, it was very, very undervalued back here. And as I showed in the article, you would have made about 20% a year holding it there. But had you bought it when I actually really wrote the article and held it till it reverted to the mean, I wanted to point out that it went above overvalued, undervalued, you're still making 18% a year. But the point is, this stock did stay. Sentiment was negative on these companies, any defense stock back in the time when we were talking about defense spending cuts, and we were only making maybe 6 or 7% a year holding it, but the earnings were flat and the price was flat and the valuation stayed very low. So it did stay low for several years. But once earnings began to accelerate again, that's the importance of what's happening to the earnings after you buy the stock is going to determine how quickly a stock recovers. Because once the stock actually started generating earnings again, you can see the recovery happen within almost virtually a year's point in time. And you'd have made a fortune here buying it if your timing was right. And there was no way to say that except if you were lucky enough to purchase it right there. I made a pretty good decision to be purchasing it or to be looking at it, writing about it back here in May or June or July of 2013. And of course, then the stock really took off. But I'd have been just as happy, I want to point out, if I'd have bought it back here, because my rate of return through yesterday's close would still averaged over 20%, but I would have had to sit through some rather mediocre performance for a couple of years. Now, with my last example, I'm going to talk about Cisco. I wrote an article on the company in November of 2012 called "Switch to This Undervalued Dividend Growth Stock to Boost Your Portfolio," and that was in, again, November of 2012, and Cisco was trading about just under a 10 PE. And you can see that the stock immediately from that point forward, and again, fortuitous timing, not great timing, started to move back, and it finally got to, reverted back to a normal 15 PE ratio, and I earned 17% a year. But once again, this was just after the company started paying a dividend. They paid their first dividend in 2011, and the dividend growth was extraordinary during this period of time. So, I did quite well. I generated almost $2,300 in dividends, and I almost doubled my money on capital appreciation. So I turned $10,000 into $22,000 over this time frame, and you see it got overvalued again, and now it's moved back into fair value. But I think the real story here, and I want to end with this because it's one of the most provocative stories that I've been able to tell, and I'm only going to be able to tell it for another short period of time. This was the tech bubble. This was the irrational, exuberant period. And I want you to notice that at my peak here, because these are only monthly closing prices, I had a PE of over 160 on Cisco. If I would have held that stock just over the course of, let's say, the next 2 years through March of 2002, if I can find it here, but there's March of 2002, I'd have lost 78% of my money over this 2-year period. Now, even worse, after the stock corrected, it didn't correct enough, and we still had very high valuation. So currently, we have a PE ratio of 15. It's trading at fair value. But had you bought it, let's say here, coming out of the 2001 recession at a PE of about 50, you could have held it for all these years here, more, let's call it a decade approximately, and lost money every year. And yet I want you to notice that the company did great. So, here's a case where high valuation impacted returns for more than a decade. But then once we got undervalued, even if I just measured it from being undervalued here when it first got undervalued, I do want you to notice you'd have been down on the stock over the next couple of years. So there's waiting a couple of years. And again, it's easy to look at this and say, oh, that makes a lot of sense. But this is, from November of 2010 to July of 2012. That's a long time to actually live through that kind of performance. But on the other hand, had you been, fortuitous enough to live through that performance, by the time you came back to where the stock reverted, to its mean, you'd have averaged over 12% a year holding the stock with great dividends and great dividend increases along. So there is no precise time, but how quickly your stock is going to recover from being undervalued is going to be very functionally related to how well the company is doing, how well the earnings growth is happening after you purchase the stock when it's undervalued. And conversely, when a stock is overvalued, even if the stock is doing well, even if the business is growing and doing extremely well, if you're overpaying for the stock, you could still suffer many, many years of poor performance even when the company's earnings growth is good. So the point is, there is no perfect precision, but there are concepts that can help you understand that if you're patient and you're a long-term investor and you buy a great company at a sound valuation and that company continues to perform well, you should have confidence, at least I do, that you'll be well rewarded in the future. Anyway, this has been Chuck Carnevale saying thanks for watching this rather long video. If you like what you see here, I encourage you to subscribe, hit the subscribe button and subscribe to our YouTube channel to see more videos as I produce them. Thanks again for watching.